questions. So we note that the question for today is labeled in terms of dependency and not imperative, and this seems to us actually more apt and more coherent with our stance in our paper, even though we confess that we didn't sufficiently clarify this. The post-Keynesian literature, MGI literature, is constructed on a coherent formal world in which every dependency can be couched in the vocabulary of imperatives. And we actually were kind of unwittingly drawn into this vocabulary. And one quite crucial question for us today and for further work is whether this was a mistake. And actually, we believe it is, but we can talk about that. The debt interest MGI is theoretically incorrect, and we've conceded as much in the paper. This means that we basically accept the stock flow consistency constraints as well as the theoretical non-contextual hypotheses that are made in the literature that criticizes the macro accounting approach. And by the same token, shouldn't we also accept the refutation of the debt store value MGI, as well as the non-bank debt MGI, which we discuss in our paper? In other words, shouldn't we accept that the whole macro accounting MGI literature is wrong and move on? Well, if it were really the case that, as the MGI critical literature suggests, everyone could pay back their loans by reducing their consumption while still covering their essential expenditures, if it really were the case that commercial banks would just passively adjust their loan money supply volumes to the demand for money, and that overall sufficient time were available for the repayment sequences to operate so that $1 of bank debt could serve to repay many dollars of non-bank loans, if all these things were actually really the case empirically, the literature that criticizes macro accounting MGIs might well be correct. But we believe that empirically these things are not the case, although admittedly we provide a precious little empirical evidence in our paper to support this belief, and we recognize that. So that the debt store value MGI, as well as the non-bank debt MGI, which we discuss in our paper, may well be operative as actually prevailing dependency factors, if not as model world imperatives. So in fact, by the same token, perhaps the debt interest MGI itself might perhaps in some form be rehabilitated as a really existing mechanism outside the abstract model world, generating real world growth dependency. So for instance, we should further inquire to what extent actually existing commercial banking practices institutionalize structurally low payment to income ratios. So actual practices and not, which are pervasive, entrenched, structural, resistant to change, as opposed to perhaps the more idealistic post-Keynesian ellipsis towards the post-growth banking system. In particular, in connection with practices linked to what we would call supply-driven demand formation for money, such as massive consumer loan pushing and loan sharking, which actually largely drove the 2008 crisis, for instance. Now, importantly, we should note that supply-driven money demand mechanisms would not necessarily invalidate the endogenous money argument that central banks do indeed passively adjust reserve flows to loan volumes, and so that they lose the control over the money supply. In fact, loan sharking is baked into banks' obligations to shareholders to maximize short-term profits. And our empirical experience of capitalism is that no private enterprise merely provides a service. They have to stimulate demand and for their services and grow faster than their competitors. So the growth in money and debt could be seen as a mere reflection of banks' contribution to the maxim grow or die. By the same token, we should also further investigate the extent to which actually existing practices by non-bank lenders de facto make it impossible for one bank debt dollar to repay multiple non-bank debt dollars, essentially because for profit maximization reasons, again, in capitalism, they never fully pay back the principal, much of which can stay on the books until it's written off. So we completely agree that the formal macro accounting MGI arguments have largely been made in an institutional and political vacuum. They abstract from the actually existing historically entrenched power relations in actual capitalism. That's why we now see that it was a mistake, not just a strategic mistake, but actually an intellectual mistake to start in our paper from the debunking of the dead interest MGI by Jackson and Victor. But we now realize by that same token, post-growth activists should probably not just blindly carry over arguments drawn from the model world, from abstract time constructs into their advocacy for real-world, real-time critiques and policy changes. The post-Keynesian idea that class struggle is central is really an important one, and we agree with that. We think actually that class struggle in some form is what underlies the structurally low payment to income ratios among all but the wealthiest people, and that this is due to supply-driven money demand, which is a mechanism which is implemented by the banking system on behalf of wealthy beneficiaries of growth dependency. So to say, as some post-Keynesian skeptics argue, that poor or even middle-class households, as well as over-indebted cities and states, could just reduce their consumption or their medical expenditures to repay their debts, potentially inducing a balance sheet recessions, seems to us just as problematic in principle, empirically, as if we were to say, for example, that the market relation growth imperative is invalid because businesses could just accept to lose money and close down, or that the wage relation growth imperative is perhaps debunked because workers could just accept lower wages, or firms could just de-escalate the distribution conflict and willingly give in to union demands. Or should we say that the rentier growth imperative is questionable because perhaps rent seekers could devise wealth stock enhancing or non-parasitic ways of earning their share in asset income flows? I mean, surely one could write up formal models where such dubious, unrealistic assumptions could be baked in, and surely none of us obviously want to do that. And this is kind of a reasoning ad absurdum, but it shows us the import of all this is that we should focus our efforts on investigating how practices of rent extraction by actors who collectively hold private monopolies over the money commons are operative in driving monetary growth dependency within actually existing capitalism. So either we accept that power relations and class struggle, hence rent extraction, play a key role in all growth imperatives, and therefore also potentially in the macro accounting MGIs, or that they could be suspended in all of them, regardless of how problematic the counterfactuals turn out to be when they're considered empirically. So in our paper, we're more interested in actually existing capitalism, less in the formal model universes, more interested in real-time blockages and urgencies, chiefly climate change and environmental collapse, and less in abstract time balancing processes. Of course, this stock flow consistency is obviously crucial, but so is real world relevance. And obviously they don't exclude one another, of course, especially when it's a question of just accounting identities. But paying attention to the lags, the delays, the blockages that actually exist, that in power relation driven mechanisms, and how they impose things on the medium and long run equilibrations of stock and flows, or on the institutional shape that the consistency takes over time, seems important to us as well. So banks, as well as non-bank lenders, certainly have a lot of power, lobbying power, symbolic power, political power, you name it, due to the societal task with which they've been institutionally entrusted of constantly buttressing growth through debt creation. And so we, I think, collectively need to find the best ways to make this inordinate power visible, and then try to break it if possible. Thank you.
Thank you very much, Christian. And then we continue immediately.
I'll stop the sharing. Yes, there you go.
With the reply from Louison.
Do you see my slides? Yeah. All right, great. Yeah, so I'm going to comment briefly. I think the comment is more based on the paper than on what Christian just explained. So I entitled my presentation on the need for growth in modern economies, a critical discussion and some suggestions, because that's how I will entitle the working paper I would like to extract from my reply later. So I will briefly give a few definitions, and I would like to contextualize the discussion so far. Then I would like to highlight also some limits of the discussion. Christian already did it to some extent, and then I would like to propose some assumptions to move forward. So just for everyone to be clear, what we mean by a growth imperative at the macro scale is the need for a society to grow its economy to be socially and politically stable. And at the micro scale, it's rather the need for an entity like a firm, for instance, to grow to ensure its survival on the market. So that, of course, also includes financial institutions like banks. So in that way of seeing things, a monetary growth imperative is a need for growth that originates in the very nature of money and or in the core mechanism of the monetary and financial system. There is another distinction that I think we need to keep clearly in mind in that discussion, because sometimes both are, I think, equated, and that's problematic, is between debt and debt money. Debt money is money created as debt, for instance, by private banks, like as credit. But debt, it's any unmade payment, because any payment is a debt settlement. So you can have debt in an economy, even if money is not created as debt initially, and I think that's important. So what was the research question of the discussion originally? It was very simply put: are debt money and interest incompatible with a non-growing economy? That was a claim that was made by some ecological economists and some degrowth economists, without consideration, without further consideration for the kind of non-growing economy or for the kind of economy we talk about. So the conclusion that was reached then by the post-Keynesian critique of this argument is, first of all, that in theory, there is no absolute incompatibility between debt money and interest and a non-growing economy, but this requires, there is a condition for it, this requires that a sufficient amount of accumulated wealth must then be spent back in the economy. And therefore, there is also a policy conclusion to be drawn from this discussion, that is that very strong wealth and income redistribution mechanisms are needed, all the more so in a non-growing economy. And that's, for instance, something that we make very clear in our paper, 2016 paper with Mark Lavoie. But of course, this discussion is also reductionist indeed, because it has been so far almost a purely macro accounting discussion, and it abstracts from the institutions and the social relation into which the monetary system is embedded. So there is a need to bring back in the social relations and capitalism, for instance, to question and understand the institutional complementarity between the monetary system and accumulation dynamics. And this is something that, for instance, Romain Schwarzman and his co-author have started to do in their 2020 chapter. So here I want to emit a warning. The general term monetary growth imperative was commonly understood in the literature, but also in the activist meeting or in the conferences discussion as referring to that debt interest monetary growth imperative. So it was actually more specific than the general term monetary growth imperative could lead one to think. And the conclusion was never that the monetary system is not problematic, or that there is no intrinsic need to look at monetary mechanisms as it is written in Christian Mathieu and Jem paper. That was never the conclusion of the discussion. So essentially, as this critical MGI literature has shown, the problem arises when there is over accumulation or even simply accumulation of wealth, because in that case, a non-growing economy cannot be fully stationary. That is, the stocks and flows cannot be fully constant, cannot stay fully constant. So that was the main theoretical conclusion of the discussion. And in the reformulation by Christian, Jem, and Matthew, the dynamics that are described, that are depicted, they all stem from accumulation. None of them stem from debt money per se. And the same dynamics could happen without debt money, just because debt exists in an economy. So therefore, the causal explanation that are proposed, they focus on debt money and they neglect accumulation as the cause. And this is all the more paradoxical, I think, as because it is really very clearly written many times in the paper that accumulation is always the starting point of the reasoning, but it is always assumed and never explained. And debt money is made the cause instead of accumulation. And so I think a theoretical result we can draw from the literature so far is that the growth imperative arises from the combination of accumulation practices and the need to make payments, which is definitional to any monetary economy. And we can reformulate that because the payment is a debt settlement. So we can say that growth imperative emerges as a combination of accumulation practices and the existence of debt, beyond debt money, but the extent of debt in an economy. And no matter how is money created initially. So debt is intrinsic to any monetary economy, but in capitalism, what is specific is accumulation. So it's worth trying to make some assumption on why there is accumulation. So in the paper, like two things that I submit to the discussion is to say that capitalism can be defined as a system that combines two fundamental social relations that are the market relation and the wage relation. The market relation, it is a specific organization of production where what is produced is to be sold. So it involves alienability and private property, and it implies a competition relation amongst producers to sell their production and therefore to survive on the market. And one of the best ways to survive on the market is to be bigger than your competitor. But this is a micro level growth imperative. And it can translate at the macro level under some conditions, because aggregate income needs to grow if many firms are to survive. And then there is a wage relation, which is a specific organization of labor based on the property separation between producers and the means of production. And this separation translates into distribution of income between wages and profit. And so this embeds a structural distribution conflict because if one of the two terms is to increase, then of course GDP has to increase as well, if the other one is not to decrease. Okay, I'm reaching the end of the time, so I will just jump to the conclusion then. So to conclude my point, what I want to say is that I was really uncomfortable with the claim that critiques of the monetary growth imperative are based on the unacknowledged pro-capitalist view, because of course that is absolutely true. Some authors do not really see the point of overcoming capitalism, but that is not true of every author in this discussion. And we could also say the reverse. We could also formulate the reverse argument, that is a serious anti-capitalist theoretical examination of the pro-MGI argument shows that it is rather shallow and confused because it mistakes consequences for causes, and it loses sight of the cause mechanism, the initial mechanism, that is accumulation. And this is somewhat, to my opinion, falling short of what political economy has taught us so far. So I think there is a need for post-growth economics to engage more with a number of political economy traditions. And I would also like to mention that, to my opinion, and we can debate that, but this is also kind of a right-wing shift in post-growth thinking, because then it leads not to question the very fundamental social relation of capitalism and focus on debt money instead. And it's, for instance, written twice, I think, in the paper that the author wants to argue that any variant of capitalism might theoretically be compatible with a non-growing economy if we get rid of that money? And I think that is a very, very problematic statement and arguably a questionable one. Thanks a lot.